But when we're talking about California, we can't avoid the fact that Gavin Newsom is yet again U-Haul's #1 employee of the year for 2022. Hey everybody, thank you for joining me on this rapid fire round of California real estate market updated. We're going to cover the top 4 markets in California. And right off the bat, we got to start this off with Goldman Sachs coming out this week and saying, hey, 4 U.S. cities are going to suffer a crash unlike we hadn't seen in a decade. Let me point out the ones that they actually cite. The 4 marketplaces they mention are San Jose, California, San Diego, California, obviously Austin, Texas, and Phoenix, Arizona, before drastic decreases of more than 25%. Goldman Sachs pointing out that there's a lot of crazy issues going on in the market here. The news of the day, just because I think it's important to point it out, is that Freddie Mac 30-year fixed rate right now is on its way down still. We obviously saw highs back in November. Today, it reports a 6.15% on the 30-year, which has brought about some positive news. But when we're talking about California, we can't avoid the fact that Gavin Newsom is yet again U-Haul's #1 employee of the year for 2022. California led the nation in outbound migration. This has been the case for a couple of years now, and over 300,000 people moved out of the state. The state, I believe, has somewhere around 40 million people in it. Florida gained 300,000 people with half the size of population, around 20 million people. So again, you know, on the whole of things, California's not going to miss 300,000 people, but the reality is it's being drained. Them in New York as well. You're starting to see people actually leave the state, and for a myriad of reasons that we're going to come back to. Housing active inventory for listings, okay? This is just active, okay? Active listings are actually down. You're going to notice in California that we have usually around 70,000 homes active at any given time. And right now we're around 48,000 here in California. And this means that it's historically a little down over what it usually is. But that's not the headline. The problem is that if you look at pricing in California, the story is it is on a slide, okay? So going back to June of last year, the entire market, including California, had seen a correction from 774,950 on the high to where it sits today at 680,000. The source of this data, this is Fred, which is Federal Reserve economic data. St. Louis Fed puts this out. They are pulling from Realtor.com. Okay, so sideways, downward slide again on the whole of California. And when we look at the fact that people are leaving, you've got, you know, just affordability just being really, really poor here. And a lot of this particular state, we're going to look at Los Angeles first, I think you're going to see the backdrop of California is really on what I would like to call a reverse auction, okay? So even though you see historically low inventory here, okay, less people are putting their homes on the market. Now, we expect some of that to change as we get into 2023, further into the year, but there's less inventory. However, you're going to see as we kind of move through Los Angeles and Riverside, San Diego, that even though people aren't listing their house as much, no one is buying. People have stepped way back. The volume of people actually picking off homes is actually stalling the market out, so that even though people are not bringing their homes into market in California, and it's much fewer, in fact, homes that are there are aging for lack of buyers. So if you imagine what's happening right now, and this is really the correction part of the marketplace shaking out. If you look at the marketplace, imagine all of the marketplace being kind of like a reverse auction. In an auction atmosphere, something comes up like a piece of art and everybody bids on that to the point where someone finally meets the high number and they acquire the art, okay? And the marketplace we're seeing now, where people are falling away from the market and literally seeing what's there, and kind of buyers looking side to side and seeing, you know, is this really a number that I'm interested in? You see price reductions flaring to record highs. So the amount of people that have houses in active inventory that need to sell are now having to cut those prices at record numbers downward, and it doesn't get picked off until buyers look side to side and say, that's low enough, I'll jump in and get it. So instead of it being bid to the top where it needs to sell, we're seeing a reverse auction where it almost bids down to where there will be a strike price. And we're actually going to see certain markets that are in a lot of trouble over these particular points. Now, As I mentioned, I could probably go into any marketplace. If you go to new listings, you can see that a year over year graph, these are years prior, previous 2 years in fact, you can see that the takeoff of this year is that seasonally it's far below what it's been at any point in the past. So theoretically, there's just less homes to buy. Yet, this is where rubber meets the road. Month of supply. Now, whenever you have fewer homes hitting the market, the amount of months of supply, which means how many months will it take to sell off everything in inventory if, based on the current pace that they're selling. So you can see that despite there being very little coming in the market, the amount of supply, months or weeks of supply in this case, is vertical. This is not good. So we can sit here, the buzzword from all the brokers, all the realtor friends, they say, well, we have no supply. We have no supply coming to the market. That doesn't matter when there's still supply. There's still listings coming forward, yet they're not being bought. In fact, this shows that vertically, buyers have left the building, okay? And being that that is the case, you are going to see some hot spots where it's just a little bit tricky for people to get rid of their home. So let's take a look. I'm pulling up a graph. And I want to give shout out to Riverside Consulting. This is behind a paywall. I don't get anything for advising this, but I do like his information. I like what Nick puts out. So go be behind his paywall. It's like $5 a month. This source is realtor.com, but it's through a data aggregator that he provides. You can see that what we're looking at right now is the amount of listings across LA on a year over year basis. So all downtown LA, you see where it's all blue? This means that there's, it's very tight inventory wise versus a year ago. You can see that on the outskirts going south, you're going to have areas like Compton right here where they're seeing, this is probably 100% over last year in some of these zip codes where there's inventory piling up. You're also going to see this, I think, as you kind of cruise around. West Covina is high. The west side of Fullerton is high on inventory. Carson, east side of Torrance. So these, outer skirts of town, a lot of folks, and this is something you want to be careful for in a housing correction, is a lot of the folks that couldn't live in the middle of town moved out of town. So you're going to see throughout the areas that you're going to see a constant shift where people, couldn't buy in the downtown areas. And as a result, they moved out of town. And now those out of town markets got so expensive that buyers are absolutely not interested in paying those prices now a year later. And so what's happening is the inventory is sitting, it's piling up, and there's a lot more on the outskirts of town versus a year ago. You can see again here just on the west edge of Burbank and then going west, northwest LA, a lot of this is huge percentage share of properties that are getting price reduction. This is a price reduction graph. So down here in the south, Downey, east edge of Norwalk, some of these areas around Anaheim, both east and west of Anaheim, a lot of these locations are seeing and these are big numbers. 50% of 90713 has price reduction. So you see these really bright red spots that are kind of on the outlier areas of downtown LA. These are the parts of town that are suffering big time price reductions in order to see their houses sell. Let's take a peek at Riverside. Riverside's going to be the same thing. Looks like down, right down here to the heart, just east of Moreno Valley, and then so right across the cross section here, and then South Valley areas. These areas are obviously seeing a little bit of a volume of price reductions being much higher. They're increasing south of Corona. But look up here, Fontana, Ontario. These areas, very, very low price reductions. I'm going to flip to active inventory. So how is inventory doing in Riverside? Again, these areas right through the heart, still very low on inventory through the middle, okay? Through the middle of town, Fontana, low inventory. Rancho Cucamonga, very low inventory year over year. Mead Valley, Paris, all this very, very low inventory year over year. Look at Riverside, same thing. Months of supply, off the charts high. So you got a 20-week supply, which is doubled. So, the amount of inventory, you can just see this was last year. Just further into the year, it just climbed further and further. And Riverside, similar to LA, is just kind of taking off in the new year. Let's take a look at a couple other graphs. One other thing I want to show you, some of these marketplaces are going to be very affected on rent versus ownership cost. This is a very interesting graph that I want to show you, particularly for LA. Look, the difference here, this is going back to 2015. So it's like a 7 to 8 year graph. You can see historically that it's always been a little bit cheaper to rent than own, right? LA has a very high-end marketplace. So you're gonna have multiple houses that skew the numbers, where you have these multi-million, $30, $40 million homes in the mix of their sales. So, historically you've seen a gap. So like, for instance, I'm looking at October of 2019, it was $3,280 to own a house in that time frame. And then over at the same time, it was $2,400 to rent. So there was a little bit of a gap. But look where the gap is today, folks. You've got a $5,636 gap to buy versus $2,900 to rent. So renting hasn't shifted the same way. Buying, back when the interest rates were, very low, housing prices went vertical. This was price, grew. Then, boom, interest rates got so bad. So it went from 3 to 6% on these already expensive homes and just drove ownership so far away. Understand this, folks. This right here is a 93% gap. This right here was maybe a 20% or maybe 30% gap. But when it's almost 100% more to buy, you lose a lot of the buying public. You lose particularly the people that were going to buy their first condo or townhouse in this particular area. And that's when you really start to see those segments of the market go into some serious trouble. Okay. San Francisco, again, similar situation where you have really high priced real estate. You got pretty close here, where it's about $4,900 in 2020, $5,000 a month versus $3,000. So it's still, I don't know what that represents, maybe a 50-60% gap. Up here, you're at $8,400 versus a $3,100 a month rent. So you have a deficit of 172%. So it's just enormous spread, San Francisco, as you can see here, really very similar in some ways to the other markets that we just looked at. You can see here in the heart of town, we are looking at a graph of how much inventory has been spiking recently over last year. You can see all these blue spots representing really not a massive change in the downtown area, particularly San Francisco and Oakland and Berkeley. But you can see on the outskirts of town, it rings a different story. So I'm going to move up further north here, west of San Rafael. You can see this particular area, 94924 is a 200% growth in inventory. Might be a little bit of a lower populous area. Don't know that area very well. But down here, you've got just south of San Leandro, you have 94759, 150%. Out here, 94502, 200%. Again, out here, west side of Ostro Valley, 94552, 340%. Bunch of these are bright red, south of Fremont, all again looking like inventory is coming up. Now, let's take a look at the inventory dashboard. You can see right here, this is a multi-year equilibrium of this market, so right around 3,100 houses. As you can see, even again, we're over, anytime this marketplace is going vertical like this and it's actually surpassing the market average, and it's actually doing that, even though there's record low people putting their house on the market, you can see that, we're 57%, almost 60% on the whole up year over year. Those are just concerning numbers because obviously if that's the case, people are backing away. Check out Redfin once again. Here we have a multi-year high months of supply. So, these years where people were actually putting houses on the market, selling them, you can see that, the market's just like anywhere else, it's spiking up. Weeks of supply is climbing, and kind of ended on the year on a high note. A lot of the West Coast marketplaces towards the end of 2022 were showing signs that their inventory was going down. But obviously, hold on. You got to see what the entire story says. We'll see what happens in 2023. I think you're going to expect to see this go up because look, seasonally, we see it spike here in California beginning of the year, and then as people start buying to make their moves through summer, you're going to see it kind of soften a little bit. But I still think 2023 is going to be a higher year over previous markets, and you're going to see months of supply just aging. Buyers are just waiting out the sellers. That's basically the bottom line of what's going on. All right, let's flip over to Sacramento, and we're going to make one last stop in San Diego. So those of you waiting for that marketplace, hang with me. We're almost there. Sacramento, again, similarly has the central market still very tight. Again, these outlying areas up north, 180%, 139% year over year. Down south in Laguna, it's 160%. Tight over here in 832, but you got 823 at 59%. You got a lot of like increases. Look at this. Out west under Rancho Cordova, you have 191% inventory growth year over year. Let's take a look at where the price shock is going on. And again, you can see those in the very similar areas. Laguna, again, a full 6 out of 10 listings, nearly 6 out of 10 listings actually seeing a price reduction in order to see their home sell. 95742, outskirts of town, here around the airport, 80%. Wow, that is a huge number. These bright red areas represent very, very high volume of price change. So those are the ones you want to keep an eye on. Inventory, look at this. Look at this, gang. Look where inventory is going. Off the floor through the winter. It's going straight back up. And I expect you're going to see this. You're going into the seasonally high time of people actually putting their home on the market. You're going to see this kind of go up. If buyer activity does not come back in, again, we are seeing interest rates drop, which is a good thing. But at the same time, even with the dropping interest rates, you're seeing all this positive news about buyers are making application. It's X% over last month, last week. You're just seeing a very small number of buyers still participate in the marketplace. And keep in mind too, buyers can apply, but if buyers can't qualify with these high interest rates, they're going to be on the sidelines at much lower price ranges. Inventory is still going to go up because they're not making purchase moves because they can't. They can't buy the home they want at the price that these are at. This is a case in point. Look at this. Again, look at the historic gap between cost of renting and cost of ownership in Sacramento. I mean, look, when you see these buy versus rent graphs that I've been showing you across this update, understand that this gap right here is the standard comfort level for the market. Okay, for the market to kind of have a gradual increase in price, like you see here, the marketplace has a tolerance for this gap. And when it gets really crazy, you lose a ton of buyers. Okay, why? Because why wouldn't I just rent? Like, renting did climb, but renting did not climb like purchasing has climbed. And that's why you're going to see people making application with lenders and still renting. Okay, make no mistake, folks. The only thing that's going to shift the market is where is the price that buyers are going to catch in order to get back in to the red line and get out of the blue line. Okay, one thing that people do not realize is the entire ladder of people, whether they're at the first-time homebuyer level at the bottom, they're in the middle class, meaning they've already owned their first home, they bought that bigger house with a pool, and then some of the people that are in the middle class, middle rung of the ladder, mid-range buyers, what we call move-up territory, those people eventually want to go into the luxury category, which is the house that has all the perks, the 3-4 car garage, the bigger half-acre lot, the bigger pool, the cabana, and the outdoor kitchen, all that. Understand this, folks. For everybody to move up the chain, there has to be buyers at each space on the ladder. And right now, we are definitely going to be lacking them at the bottom. And if people aren't buying into the bottom rung of the ladder, there's no room for people to be moving up. And that's what drives appreciation further up into the higher realm. So like a lot of the marketplace is interconnected. Okay, now keep in mind, luxury downward doesn't work that way. Luxury can fall apart and it won't necessarily affect the bottom. However, until you see these gaps right here close, okay, you got a problem. Good news is they're pointing at each other. You see the top of the graph for how the cost of ownership. And by the way, cost of ownership is being impacted because prices are softening and also interest rates are softening a tad. They were up around 7% in November. Now they're low 6%. But also, we'll have to see what happens with rents. I'm surprised that you're actually seeing rent growth recently on the charts in Sacramento. That's incredible. Let's take a look at San Diego. All right, folks, we're in San Diego. We are seeing months of supply was on the floor for the last 2 years. You can see that it's much, 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 much higher. You're talking 300%, 200 to 300% higher than it was at the start of prior years. This is a huge gap, folks. All this represents is that buyers have left the building, sellers are languishing on the market. What few there are, okay? Because you're seeing a lot of this this situation where people are looking at the marketplace and are just kind of in shock. But look at San Diego, okay? What we're looking at right now, year over year appreciation here. Year over year inventory, that is. Amount of people that are listing their homes versus a year ago. You can see that, again, downtown area, real right down the middle, 92101 is actually down over prior year. 92105 just slightly up, but really not even worth talking about. These areas right down here near the airport, all of these areas are really kind of flat. They're right where they were last year. It's not a necessarily huge number above prior year, but look at this. So you have in Rolando, you have 92115, 112%. These are going to be very impactful for these areas. So 92124, 92111, 150%. I mean, folks, that matters when nobody is buying, when the amount of people that are actually in the marketplace step way back. Chula Vista doing great in terms of inventory. It may not mean that there's price growth. It may mean that people are still just stagnant. You got Lakeside out here, really nothing much changed. May not be too much for it to be changed. I don't know how populous that area is. But you got North Santee is booming the inventory. 92131 Scripps Ranch, north of the Marine Corps installation there, also up. 100% 92122. So you go further north. Notice the coastal areas. You got La Jolla, Encinitas, Solana Beach, living large and in charge. Carlsbad, Oceanside, he goes all the way up, all the way till you get to 92508. You got a big jump up here, which I've driven this stretch. I don't remember how populous this is. I feel like there's housing and residential all the way beyond Carlsbad, but again, these areas just inland are bumped. They're going up. Why? Because, these are ocean, really close to ocean. These have high demand. Very hard for these kind of areas to lose steam, especially when there's still a lot of money in the marketplace. People still got some stimulus money sitting around. People borrowed money, probably sitting around. People out here that have equity lines out of their current residences are sitting fat. They can still possibly pick up and do things. There's a lot of wealth mobility that kind of supports these particular markets, and they're, again, not as tethered to other cost as the lower end. So gives you an idea of what's going on here. I'll kind of run up here. You can see literally just inland from Solano Beach, off of the 15. A lot of these areas are just bumping. 92029, 250% in growth. Let me take a look at the price reduction. So see how much people are reducing to get these things sold. Look at this. So again, along the coastline, pretty much the same thing. You can see just south of La Mesa, around here, north of Lemon Grove, these areas are seeing big hikes. So 92115, 941, these areas are going to be opportunities for people to see big declines. Over here, 92123, 92122. Don't know if anybody ever wants to live in those areas. I mean, not sure of the details on that, but these areas are going to see some change. You got some down here underneath Chula Vista. Chula Vista, 29%, not a crazy big number, but creeping up. You're seeing some people that are probably putting their house on the market a little too high, and they're having to adjust on the way down. All right, let's take a look at this. Look at this. Okay, so this is why you're seeing downtown still pretty stable, because the historic average is around 4,000 listings, and they're at 3,200. So they're moving in the direction for there to be more of a chill, but it's just not there yet. Look at this, folks. All right, so again, you see the nominal rent gap. Okay, this is what people are comfortable with getting out of the rental world into buying. Okay, so this was a $2,300 a month rent on the average in 2019, 2020. Goes up to $2,979 to rent around the same time, right? So that's a difference of $600, something like that. That's only 25-30%. Right now there is an 84.6%. So the normal gap between comfort level of rent and own is like more than tripled. So you're 300% over norms. So people are having to buy in at $5,520 on the average versus $2,991 on the typical rent per Zillow. Okay, again, the rents the rents are tailing off. This is what cracks me up, is you'll start to see pricing correct, pricing and interest rates correct, and then you'll start to see the rents kind of go away from it, and it makes it even harder because the gap stays wide. Now rents is obviously not falling at the same rate cost of ownership is, but look at this, folks. The rate of ownership, you see this standard peak right here, this like twin peak, if you will, where it went up, up, up. This was all price to here, as I told you before. And then when it settled and shot up, this was interest rate. So cost of ownership was first guided by a rocketing price with dirt cheap interest rate. And then when the market was stalled out, the Fed started doing what it did to push back the marketplace and try to stymie inflation. And what happens? You disincentivize buying even further. You drove this number even higher. And now look what's happened. It's almost back where it was. Like the interest rate hit and the price coming down here about, this is December, this is June. So in 6 month time, the number shot way, way up, and then it's actually getting close to just the peak here, but it's got a long way to go, folks. Okay, bottom line, this is it, simple as this. When you look at all this data and you look at each of these markets, if you want to go back and look at the buy versus renting graphs, the longer it takes for rent and buying to get back to its norm, okay, that's how long till you see prices balance out. Okay, so in California, particularly let's say in LA, you take maybe right here, $3,300 a month December of 2019 and $2,400 a month. 35% may be the comfortable tolerance, right? It's triple that. Okay, so what's going to happen is if interest rates come way, way down again, okay, then that will eat up some of this distance. If interest rates come down, then it saves the price. But all intents and purposes, I don't see that that's going to happen that rapidly. I think more or less what's going to happen, buyers are going to stand off until price gets more available to them along with the interest rate. Hey everybody, do me a huge favor, smash the like button. For hard-hitting data and great updates on the marketplaces around the country, stay tuned to the channel, hit the subscribe button, and let's watch this market correction together. We'll see you real soon.